Great. Good afternoon. Welcome everyone to this webinar by the CFA Sustainable Committee. I am Augusto Caro, Global Head of SRI at SAM and Head of the committee. As you well know, CFA Institute has shown a growing commitment to sustainability, reflected in the increasing inclusion of topics related to sustainability themes in its curriculum and in the offer of specific trainings. The result of this was the creation of the CFA Spain Sustainability Committee, which was born in 2019. Among the objectives of the committee are to promote and strengthen in Spain the recently renamed CFA Sustainability Investing Certificate, to publicize other CFA Institute certifications and courses linked to sustainability, such as the CFA Climate Risk Valuation and Investing Certificate, expand the dissemination of CFA publications and research resources, regular participation in the dissemination of opinion articles, promote an annual conference on sustainability that it is going to happen probably on the 29th of October this year, and the celebration of webinars like the one we have today. It is a real pleasure for me to have one of our sponsors, Amundi, the main French asset management company. Thanks, Julia, and thanks especially to Marie Bruyère for this webinar entitled Artificial Intelligence for Sustainable Finance, Why You Can Help. With Marie, we will explore how artificial intelligence, AI, can enhance the quality, availability, and reliability of ESG, environmental, social, and governance data used in sustainable finance. It investigates how emerging technologies such as natural language processing, NLPs, large language models, LLMs, and satellite data can address the limitations of traditional ESG data source and improve investment decision making. Marie Berg is the head of Investors Intelligence and Academic Partnership at Amundi Investment Institute in Paris. In her role, Marie conducts research on portfolio choice, focusing on sustainable finance, family finance, pensions, and the impact of fintechs. His work is instrumental in advising the strategic decisions of institutional investors and designing investment solutions for individual investors. Marie also holds important positions in various institutions. She is the president of the Institute for Quantitative Investment Research, Inquire Europe, scientific director of the FAIR program at the Institute Louis Bachelier, and chair of scientific committee of the European Savings Observatory. In addition, he is a member of the group of experts that advise ESMA Risk Committee and is part of several scientific councils such as the French Supervisory Authority. Many thanks, Marie, for having, it is really a pleasure for having you here. I just want to say before you start that everyone that are willing to make any question, they can write it on the chat and I will try to read it to you. So thanks, Marie. The floor is yours to give us your knowledge about this interesting topic. Thanks a lot.
Thank you very much, Augusto, and thanks for inviting me to this webinar. I'm delighted to be here to talk about artificial intelligence for sustainable finance. So, as we are all well aware, AI is transforming our economy and also transforming our jobs. So many of us are using ChatGPT daily in our daily activities. And it's quite difficult to forecast what will be the future of our work, but we can already see a number of disruptions in the way we now work and use artificial intelligence. So if you try to assess what will be the impact of AI on finance in general, and I will make a special focus on sustainable finance because I think it is an area where it is particularly useful and powerful. You can basically, and that's ChatGPT's answer. So you see it's already using AI to make my speech. There are different parts of the investment and financial activities where AI can have a very large impact. The first part is about quantitative investment. So you can use AI for data and predictive analysis, for algorithmic trading, for quant analysis and portfolio management. The second part where AI is very relevant also in the financial industry is for clients relations. Customer service and customization, robo-advisors will be disrupted by, in particular, large language models and the use of AI. And the last part, which is probably the part which is already in place in our organizations, is related to all the efficiency gains that we can get with AI. So in a number of activities can be credit scoring, regulatory compliance, marketing checks, fraud detection and security. There are many, many places in our organizations where AI is now used to make efficiency gains, so to gain operational efficiency. And of course, all that poses some regulatory and ethical challenges. And if I have time, I would like to delve a little bit also in the risk, because there are a lot of opportunities in using AI, but there are a couple of risks as well that we should be quite aware of. All right, so if we start with the first part, which is about quantitative investment, AI allows to do a lot of things, but in particular, it allows to incorporate what we call alternative data or unstructured information. So information that is not available in a quantitative way, where you do not have a figure to measure it. And sustainable finance is an area where sometimes we do not have figures or not immediately figures. Maybe we can transform information into a number, but it's not immediate. So that's why it's particularly relevant in that context. So there are many sources of alternative data that we can use, can be text or sound. And for this kind of information, large language models are particularly relevant. It can be images as well. I will come back on that because satellite imagery is something which is very, very important and relevant for sustainable finance. And it can be other sources of data like sensor data, etc. And then, of course, you can use various techniques to recover this data, then process it, etc. So it goes from web scraping, NLP, speech recognition, computer vision, of course, machine learning to treat all that. I will give you some examples on in particular in the sustainable finance space. So I told you sustainable finance is an area where it's particularly relevant to use AI. And in particular, because the ESG rating have been highly criticized. And in the recent years, I'm sure you have been discussing that as well in your committee at the CFA. There was a huge debate on how we should use this ESG rating and a lot of criticism. Part of that was coming from academics, and there were a couple of very prominent papers, the one by Berk and Rigobon, for example, was highlighting that the ESG ratings are not as correlated as we would expect, that there is a subjective choice of what is considered relevant ESG criteria by the rating agencies, and this choice might differ from one rating agency to the other. The ratings are reviewed infrequently, often with different timings, and also when there are missing data, there are different imputation methods used by ESG analysts. So these are all the criticism we can make for ESG rating, and of course, very, very difficult to create an ESG rating. But I think part of the development of what we see now into alternative data in sustainable finance is also related to that criticism and the fact that we would like to revise in a way the sustainable ratings and maybe use alternative sources to complement them with other sources of data. So I like to spend some time on textual analysis because for me it's particularly relevant for sustainable finance. So textual analysis has been changing tremendously over the last 10 years. So we started with very basic techniques. We started with what we called NLP at the time. So we were doing topic classification, raw language processing, sentiment analysis with very basic tools. And now came the large language models, and it has allowed to make all these things much more efficiently and with a much better quality. So I'm going to show you a couple of examples of what is done, what we can do with this kind of data. So one thing we can do with text is build sentiment. So we can build sentiment on basically everything. It can be sentiment at the company level. So are we positive or negative about the company's financial prospects, for example? But it can also be on sustainability issues at the company level, also the aggregate level. So here I quote a couple of examples from research that were building climate sentiment indices. So which just measuring the general attention that the public might have to climate issues from newspaper articles. So how much does the media talk about climate? And interestingly, and we have a paper on that as well, climate sentiment is related to the outperformance of green versus brown stocks. So typically, when climate sentiment is high, the green stocks tend to outperform the brown stocks. So this sentiment has a large forecasting power on stock returns in particular. I quote here a couple of academic papers that were dealing with this issue, but of course, there are many different dimensions of sentiment that you can measure. You can identify firms' controversies. That's something very important for sustainable finance. Firm controversies have a very large impact on firms' performance. So when there is such an announcement, the stock market, the stock price typically drops. And there are already commercial offerings of firms' controversies data. For example, RepRisk, one of the data sources we've been using at Amundi, is proposing indicators at the firm level, classifying all E, S, and G controversies at a company level on various subtopics and allowing to identify what's happening on a given firm at a given time. So it basically counts the number of controversies happening in a given month, for example, and also build a rating, an index based on the intensity of the controversies. It's quite important because, as I said, it has important stock market reaction. A lot of investors react to that. We have a research paper looking at how employees react to these controversies, and we find that in terms of employee stock holding, so we look at companies offering employer stock to their employees, and we find that employees buy less of their employer stock when there are bad news about their employer. So it's something that a lot of drives a lot of attention, let's say. You can measure the credibility of companies' concrete commitments. So, for example, identify compliance with TCFD. I mean, the TCFD itself has been working on that. And something I find particularly interesting and valuable, and there is a lot of research right now on that, is identify greenwashing. So there are many different ways you can measure greenwashing. One of the ways to do that is to identify cheap talk. So by firms. So when the firm talks about a sustainability topic, which is not completely related to its business, its main operations, for example, that might be an indication of greenwashing. So when it talks a lot about something which is not essential for the business, but is completely silent on other parts where it might matter a lot, for example. So all that can be done by analyzing the communication of the firms. Could be through earning calls, regulatory filing. So there is a lot which is done now to analyze the company's communication. I will come back on that because that raises some challenges and risk as well in terms of manipulation. Because if you're listened by a machine, there might be some temptation also to twist your communication in order to influence the way you will be perceived. And that's what CEOs are right now doing. Large language models, as I said before, we're completely disrupting that because now you can do all these tasks very, very quickly, analyze text very efficiently with a lot of precision. Of course, these models they are not perfect. We know they are hallucinating. So for many tasks, they are certainly not perfect. But for example, for topic classification, I mean, been working on that myself, and they are really great. And I mean, we had some exercise where we're comparing the tagging and classification on topics compared to human, what human would do, and the performance was really comparable, and even in some cases even better, depending on the competencies of the humans that were doing this kind of task. But they are very good at understanding text, and in particular classifying in various topics. So you can ask LLM various questions about sustainable finance, and you can, of course, estimate sentiment. So here I take an example which is not on sustainable finance, but of course it could be developed on sustainable finance as well. In the recent months, there were a couple of research papers that were published on the use of LLM, and in particular ChatGPT, to derive firm level sentiment, so an indicator if it's positive or negative for a given stock, and then a trading signal based on that, with quite impressive results, and with very, very basic prompts. So, I mean, I copied the prompt here, and it's more or less the same in all the papers that I quote here. So the prompt is very basic. Pretend you're a financial expert. So you tell that to ChatGPT. With stock recommendation experience, answer yes if it's a good news, no if it's a bad news, or unknown. And with that, you get an indicator which tells you if you should buy or sell. So you can do that on earnings call, for example. So you have a trading signal. So with very, very basic prompting, you can get results that are now really amazing. And of course, if you want to develop some applications for sustainable finance, there are many fields where it's very relevant. For example, that's an example of a paper estimating scope 3 emissions that are traditionally missing. I mean, not so many companies are reporting these emissions. And it's doing that from the financial transaction of commodities, from the US environmentally extended input and output data set, for example. So what the LLM basically does is classify the transaction data into different commodity classes. So that's something that manually would be very, very painful, but the LLM can do that very quickly and very efficiently. Another example where we are working on as well ourselves is in the field of innovation. And in particular, we're working on climate patents. So we have some research on that, on what are the firms that are innovating in terms of climate innovation, issuing climate patents, and what type of patents are they issuing, and how disruptive is the patent, how many applications can the patent have, etc. And of course, as a finance specialist, you are not a specialist of engines, for example, or many climate innovations where, I mean, you know absolutely nothing about. And that's where LLM can be also very, very valuable, because they can understand much better than you do, or as we do, the text of the patents, which is typically very complex. And if you're not an expert in that field, very difficult to understand. So you can, for example, ask ChatGPT to summarize a patent in non-technical words, and then use a summary, so first to understand better what the content of the patent, but then also to see how disruptive the patent is. And you can also do that with textual analysis by checking how far the, for example, text embeddings are for a given patent to a cohort of past patents that have been issued by other firms. So by these kind of techniques, you can check how innovative, how disruptive a given patent is. So that's something which is particularly interesting. So in a field where you are not completely competent, but you would need insight to value the company, to evaluate its climate policy, and in particular on innovation, this can be particularly relevant. So I talked a lot about textual data, but there is a lot you can do with images as well. And one field I find particularly promising is the field of satellite and sensor data. And in particular, satellite imagery is particularly interesting because there are a lot of things you can measure from satellite data that is not available elsewhere, that is not quantified in traditional sustainable data sets, nor is it an information that can be inferred from the communication, for example, of the management of companies. So I can give you a couple of examples that I find particularly relevant. You can verify, for example, carbon emission of companies or analyze their impact on the ecosystem. For example, you can measure deforestation with satellite imagery. And I give you some example of images where you can check how far deforestation is growing, for example, around a given firm's facility. So that's an example. But you can also measure air pollution caused by forest fires, the water quality. So there are many things you can infer from the satellite data. So once you created all these signals, and in particular many sustainable finance signals, then it's of course also very tempting to aggregate all that with AI and do that, for example, with machine learning techniques, which are particularly relevant when you have a very large number of variables, a large number of characteristics, for example, for a given firm. And with the rise of alternative data, we also have a growing number of characteristics. So if you consider all the financial characteristics of the firms, you have, more than you have hundreds of indicators you can look at. And if you add to that, for example, sustainable finance indicators, you can have a very, very large number of predictors. So of course, with very large number of predictors, the standard, regressions, linear regressions are not so much relevant. So it can be very tempting to use, for example, machine learning to aggregate all this information and derive a trading strategies. So there are a lot of research papers on that, trying to find the best predictors. So what are the best techniques to forecast stock prices? And I quote here a paper which has been very influential by Gu and Kelly, because this paper is comparing a large number of techniques, goes from simple OLS regressions, so linear econometric models, to neural networks with up to 5 layers, so deep learning techniques, basically, and compare their performance. And the graph I show here is from their paper, and is comparing the R square, so the predictability of these different models on a data set of individual stocks in the US. And what you can see here is that either on the long or short side of the strategies that they built, the more sophisticated models, or the more complex model, for example, the large neural networks that you can see on the right part of the chart, are the one having the best predictability. So they have the highest R square typically. So this paper concludes that we should go complex. So we should use more complex model once we have all these beautiful signals to derive investment strategies. I would be a little bit more cautious, and I'm going to show you examples where we're not. Should be a bit cautious in using these techniques, because they, in aggregate, perform very well, but there are instances where they do not perform so well. You can, of course, use also this machine learning to predict, and that's also something which is developed at Amundi to predict trading costs. So that's an example of our own research here as well, where we forecast the trading cost of a given trade based on the stock characteristics, but also the order attributes. So for example, the trade side, the size, and importantly, the order imbalance. So how imbalanced the market is at a given time. And that allows you to forecast the implementation shortfall. So in that particular paper, we were using Bayesian network, in particular to handle missing data. So when you trade, typically you do not know the order imbalance at the time where you trade. So, but it can be inferred from other variables, so in particular the stock characteristics, etc. So these kind of models allow you to handle missing information, so they can be particularly interesting in that context. So do all these techniques bring value? Because I mean, we can complexify and can use more and more data, but it's still an open question if it matters, if it makes sense, and if it brings performance, allows us to design better portfolio. So, I mean, it's a very complex question. So I will give you some partial answers also based on some of the research we did. And I'm cautiously optimistic, I would say. There is value in that, but I think we should be a bit cautious. For example, if you think about the new data set that we can build, in particular in the space of alternative finance, of sustainable finance, sorry. I mean, of course, if you are able to derive a new data set, it gives you an informational advantage. So if, in particular, only few market participants can have access to that, that's particularly valuable for you. But, and there is a but, this informational advantage typically disappears quite quickly. And that's something we test in one of our papers. So we had a very nice textual analysis of news. And then we realized that a lot of this information is processed immediately by the market. And it's very hard to get information that allows you to build the trading signals considering day T+1, T+2, so some forecastability of the information you're using. So I think the message here is that a lot of this alternative data or these techniques allowing you to decipher new information, new textual data, etc., unfortunately is more and more used by market participants. So the informational advantage that comes from the fact that you can trade maybe more quickly by analyzing this information very fast tends to disappear through time, and it's not completely easy to gain from that. Or maybe I'm going to focus on just this point on the forecastability. I told you before that more complex models have better performance in terms of forecasting stock returns, and it's particularly, I mean, it's true. I mean, we replicated the paper I mentioned before by Gu and Kelly, and we found similar results. But we went a little bit further by looking at different time periods and looking at when the models were good and when they were not so good. And this chart here show you, so you have all the models are represented by a given color, and on the x-axis, you see the ranking of the models. So these graphs, if you look at the first bar, for example, it tells you the percentage of the months in our sample period where each model appeared to be the first one, have the best performance. And what you can see here is that many models appear first. So there is a lot of color in this first bar. So not only the sophisticated techniques, so not only the 5 layers neural networks that you can see in red here appear as the best technique to forecast stock return. Also some basic techniques like OLS are better in some circumstances. And it's the same if you look at the last column, which tells you which one is the worst model. And of course, there are less red in this last bar. So the more sophisticated techniques, they appear less in the worst types of models, while the less sophisticated one appear more, but they are still present here. So there is no unanimous model that would be good in all circumstances. So you should be really careful because they tend to be quite unstable. So in this paper, we were proposing an aggregation of techniques. We have a particular aggregation. I'm not going to enter the detail, but that is represented in black here. So basically, it's a kind of sophisticated average of all these models. And as you can see here, our aggregation performs much better than each individual model. So it's a way to robustify in a way by aggregating different models together. So I think that's also something to keep in mind, that performance can be quite unstable and there is not one unique model, even very sophisticated, that performs well all the time. I'd like to say a few words about customers' relation because I think it's very, very important. And it's also connected to sustainable finance in a way, because now we also need to ask our clients what are their sustainable preferences. I mean, with MiFID in Europe, we need to ask what is their preference for sustainable topics in order to be able to advise them the right products. And AI can be also very, very relevant for addressing all these clients' relationships. So it's a topic where we did a lot of research, in particular on the robo advisors, looking at how much robo advisor improve people's investment decisions, so retail clients' investment decision with quite optimistic results. We found that it helps designing better portfolio, rebalancing portfolios through time. So it reduce behavioral biases. So these robo advisors are quite powerful. But another area where AI can be very powerful is through chatbots. So we see a lot developing right now on sophisticated chatbots that are built on a large language model. So typically through ChatGPT, for example, and which is through questions trying to decipher what the personal profile of the clients, so what are his or her financial needs, but also sustainable preferences. So you can ask very fine questions typically with LLM, and then it's an area where we see a lot of developments. Of course, it's something where supervisors are very keen also to look at, because it's potentially quite risky as well, because these models can hallucinate and clients can play also a little bit with them. So I think it's an area we should be very, very careful as well. But that for sure can improve the client's relationship. Let me skip all this in the interest of time. I'd like to spend a few more minutes on some of the issues and challenges that we have when using AI. I think we should be quite well aware of all these challenges and risk when you're using these kind of techniques. So one of the challenges is the issue of transparency and explainability, and also the issue of data quality. So, and that's particularly true in sustainable finance, where we know that on a number of topics, the data quality can be poor. So AI can be a black box, and it's even more true with large language models, which are, I mean, with billions of parameters, for sure, completely a black box. Plus, these models are revised dynamically by the providers, and we have very little transparency on how, OpenAI, etc., are revising these models. So, I think that's one of the issue when you use that is the replicability. You're not sure you can replicate your results using a new version of ChatGPT, for example. So, and you're not sure to understand why you cannot replicate it as well. So, I think that's becoming a more and more important issue. There is a question of the responsibility as well. So if you're using these techniques to have a signal for investment or to communicate information with clients, and if you base this signal on, for example, ChatGPT or an AI software, I mean, you are ultimately responsible of the information you give, but you do not necessarily master what has been happening and what the data provider has been doing before. So the question of responsibility is very, very important right now. And of course, if you externalize some parts of the process or the creation of some data sets, you ultimately remain responsible of that. So that might create some issues. Data quality is a big issue. I mentioned in particular in the case of sustainable finance, a lot of these alternative data, they have typically low geographical coverage. So you don't have every geographical zone that is covered. Typically small historical data, so you cannot have the long histories we are used with traditional financial data. So that might create some issues because that might create an over reliance on the short run if you can only use information that is on the recent past. Another very important challenge that we should be aware of is manipulation. So I told you before, if you're analyzing how the CEO is talking about his company, and in particular on the field of sustainable finance, how he describes his climate policy, social policy, etc. Of course, it's very tempting for the CEO of this company to inject the words that the LLM will detect as positive, so that you get the highest possible sentiment when you build your sentiment indicator or any kind of indicator on the prospects of the firm. So this manipulation is quite tempting. So here I talk about CEO, but of course there could be many kinds of manipulation happening. So typically on alternative data sets coming from social media, I mean, we use more and more social media, for example, to decipher what is the market sentiment. But here it's very easy to manipulate this information by injecting information, and that has happened already. So I think we should be careful that these techniques, they are quite sensitive to adversarial attacks and can be easily manipulated. Another issue which is quite dear to supervisors right now is a question of market efficiency and market stability. So one open question is, do all these signals, and in particular the proliferation of alternative data, does this make market more efficient? So the quick answer could be yes, because you have more information, because you're able to process information more quickly. You might think that it is improving the market efficiently because information will be incorporated into prices much quicker. But having a second thought, I think we should be a little bit careful because it also depends on the quality of information. For example, if your information is biased or if it's very volatile, maybe you're going to incorporate quickly information, but then realize a few minutes later or a few days later that information has been manipulated or is not relevant or is flawed in one way or another. So that issue of quality of the data that you're going to incorporate is very crucial. So of course, you can be quick in incorporating information, but there is a kind of trade-off between the speed at which you can process information with AI and the quality of the output that you will get. So there are very interesting academic papers on these questions, and it's not completely clear that we gained a lot in terms of market efficiency. Another big issue is market stability. What supervisors fear a lot is coordinated actions by AI. So if you have different, for example, trading engines, trading agents that are using a given AI, and these AI give similar signals, they might trade in the same way, and this might potentially amplify market movements in one way or another. But what they fear in particular is that it might exacerbate some market crashes. I think we're not there yet because these algorithms are not so used on financial markets. So if you look at the number of funds that are AI driven, or at least that pretend to be AI driven, they're not very numerous right now. So these strategies are cautiously used by portfolio managers. So there is no risk that these trading strategies would be used by everyone in the market. Plus, it's not also obvious that these techniques, these AI signals, would be more correlated than more traditional ones. So we looked a little bit into that, looking at the correlation between different machine learning algorithms, for example, and we didn't find that they were particularly correlated or that they would be more correlated than more traditional forecasting techniques. The last point, the last issue I would like to mention as a part of the challenges are the costs associated with the use of AI. Creating alternative data sets is particularly costly. So either you acquire it externally. So for example, for satellite imagery, you can buy directly signals, but that's quite expensive. Or you buy, you process free data, but then you have the cost of processing all this information, hiring quants to do that, storing the data, etc. So that can easily become quite expensive. And of course, that raises another question of inequalities between small and large institutions, because not everyone will be able to use this kind of alternative data techniques, etc. And the last cost we should be very aware of is the carbon footprint. Using large language models is typically much more costly in terms of carbon footprint, so carbon emissions, than traditional, for example, Google request, etc. So there is a lot of debate on how much carbon emissions LLM are generating. So everyone disagrees on that. I give some figures here in the slide, but they are constantly revised, and so it's hard to get a rough, a good idea of how much that costs. And the data providers themselves are not very open and transparent on that. But I think we should be also very, very careful on these questions, because with the proliferation of these tools, huge data sets, use of power consuming AI techniques can have a large impact on the carbon emission of our institutions. So just to conclude, will AI lead to more sustainable finance? I think there probably yes, but there are of course pros and cons. So the picture is not completely rosy going forward. So we can expect improvement in operational efficiency for sure. Incorporation of unstructured data might lead to more efficient markets. And for sure, we can hope to get more efficient clients interaction in the future. But there are also some issues that I mentioned in red here: large cost, issues of explainability and fairness, informational advantage can disappear very quickly, making it difficult to gain from it concretely. The increased risk of manipulation, issues of trust of these algorithms. So I think there are important questions and risk to monitor going forward. And an important challenge for all of us, I think, is how are we going to interact with AI? So this question of human AI interaction. So are we going to manage AI? Are we going to be managed by AI? And what's the efficient split of task between humans and AI? So we are probably good at verifying some information, but how to split the work efficiently is something which is particularly interesting in our jobs. And I'm quite excited to see how we're going to work in the future, given all the tools that are now at our disposal. I think with that, I like to stop. You have a couple of references. If you're interested, you can download some of the research papers we produced at the Amundi Institute on these questions. But I will stop here, and I'm very happy to take your remarks, questions, and discuss all of that.
Thank you, Marie. Very, very interesting. And yes, there are some questions. There is one question coming from Susana Martinez Meyers. The question is the following one: are there any easily accessible tool available that you would recommend for textual analysis? Any favorite tool for you, Mary?
I mean, using ChatGPT is just great. Huh? Then everyone can have its favorite large language model. So some consider that Claude is, for example, much better to decipher more psychological perspective, etc. So people have different view, and it certainly depends on the task. But yes, just prompting ChatGPT in a basic way is just great. So I think that the easiest and probably most efficient way to start with.
Many thanks, Maggie. There is also another question from Christian Torres. In your field, which other asset management firms, including hedge funds, do you personally think are in the frontier of innovation and usage of new sustainable data sets?
Ah, it's a tricky question.
And besides Amundi, of course, that I
Oh
think
yes.
it's in in a really good situation in incorporating all
Yes, no,
this.
I'm not sure I have a strong view on that. I think Europeans are quite good in that in general. So for sure, we are more advanced than in the US on these questions, so in particular in the field of sustainable finance, because we've been dealing with ESG data for a much longer time. So yes, I see a number of organizations that are that are working with more data sets. So complementing the traditional, everyone is still using ESG rating, so for sure, but trying to complement, so I'm not going to give names because of, for sure, small boutiques that are specialized in sustainable finance. They typically try to be quite advanced on that. So I'm not sure I'm willing to give a particular name, but I think what asset managers, from my conversation with some, people working in the field, what they are doing is gradually complementing the ESG rating with some data that are available in the market. It can be through partnership with fintechs, so partnering with a new provider of data and try to elaborate some additional indicators that can be useful, or developing in-house, and that's something we're working on. For example, at Amundi, we have a big project on climate physical risk, which is a very big issue going forward. So analyzing how much companies are exposed to climate physical risk. And something which is very important to assess is how much companies are adapting to these risks. And we are working on adaptation measures that are based on the communication of companies. So here we're using large language models to analyze how the company is communicating about its adaptation strategy. And so that's just one example, but there is a lot you can do if you're interested in a particular topic, a particular climate risk, and in particular use textual data to analyze how the company is communicating about that, and maybe checking with other source of data.
I have also a question from Jose Maria Serrano. Have you find ESG data useful in stock returns predictions?
Ah, it's a it's a very interesting question. Um, so it's related to the question: do ESG companies, the best rated companies, do they outperform or not? And there is no, I think there is no consensus on that, because it really depends on which kind of criteria you're looking at. So for example, there was a lot of debate on carbon emissions. So if you're looking at carbon emission, you find some particular result. If you're looking at carbon intensity, you can find very different results. So even academics have been, top level academics have been fighting for that, because they disagreed on this question. So I think the short answer is that there is no clear relationship between ESG rating and performance. What has happened, and that's something we should be maybe a little bit careful on, is that some rating agencies, they have revised their criteria in a way to get higher correlation with performance. So we have to be very, very careful when we are using ESG rating, because sometimes the rating we get now is not the one that was at the time when we were having access to the information, because they revised their methodology. And there is some academic research proving that they revised typically in the way of increasing the correlation with performance. With the, they did that because in a way they wanted that their criteria are relevant for stock picking, for having performing portfolios. So the reason they did that was, had good intentions in a way, but that creates artificial outperformance that you might not have been able to have if you had trading on the ESG rating at the time. So it's completely artificially created by the rating revisions. So that's an issue maybe to be aware of and careful on.
Okay, great. Maria, I have a last question. We are seeing that many providers are claiming that they are using AI. You have mentioned rep risk.
Mm,
We know Clarity AI. They
mm,
claim that they are able to have more information in a higher speed available to
mm.
customers and to clients. What's your opinion about those providers versus the traditional ones, the MSCI or the Sustainalytics? And How do you think everyone is coping with this new wage?
I think they are bringing a real value added. And in particular, when they started, they brought a real value added because no one was doing that way. I think it's gradually incorporated by traditional rating agencies as well. So, for example, controversies are used by the traditional ESG rating agencies as well. So, maybe not with AI, so maybe not as fast, but they still incorporate information in the rating. So, my view on that is that there was some advantage of these. Fintechs in the first place because they were the first to offer the service, but it will be commoditized. So the traditional providers are gradually incorporating this information as well, and large asset managers are doing that as well. So I think progressively it will disseminate in the different organizations.
Okay, great. I think, okay, there's another more question. Could you name some academic research which have analyzed if issuers with some type of sustainable tag are able to use to issue debt at better levels versus non-ESG label, in particular the S or the E or the S?
Oh, that's a very precise question. So I'm
Yeah,
not
it's
sure I
coming
have
from
it.
Christian Torres.
So thank you.
Good question.
Thanks. Thanks for the good question. I will need to check honestly because no, not on the top of my mind. I don't have this paper in mind. It's a great question.
Okay, great. Perfect. I think that there are no more questions. I just want to thank you again, Marie, and thanks everyone for attending the meeting. It has been a real pleasure.
Also a pleasure on my side. So thanks for all your great questions and thanks for inviting me. It was a pleasure.
Okay, great. Good afternoon to
And
everyone. Thanks a lot.
have a good evening. Bye bye.
Good evening. Bye-bye.
Thank you.